Good, so it's about 4 o'clock, so we are ready to start. So thanks everybody for joining this digital insurance forum on the topic pension finance and long-run productivity. Thank you very much for the discussions of today. Roel Beetsma, Jim Poterba, and Rauh. This is a very fantastic group of people we have together, and I'm very happy to see you. And so let me take a little bit of time to introduce the speakers of today, a little bit more, and then we go right into the topic. So sorry, I have the wrong screen here open. Okay, so Roel Beetsma is from the University of Amsterdam. He's professor of macroeconomics, and he's currently also the dean of the Faculty of Economics and Business. And among other positions, he's member of the European Fiscal Board. Thank you very much, Roel, for coming today and joining us. Jim Poterba is professor at the MIT Economics, and he is the president and chief executive officer of the National Bureau of Economic Research. Thank you very much, Jim, that you make this possible today. And Rauh is at the University of Standford at the Business School. He's a professor of finance, and among other positions, he's also a member of the Congressional Budget Office's panel of economic advisor. Thank you very much, Josh, that you make this possible. And I was very happy to have some prior exchange with you where we coordinate a little bit on the topic. And let me say also to the general audience, if you have any questions, please either type them into the chat or raise your hand. And we are going to unmute you, and you can then unmute yourself and ask the question. So feel free to jump in any time. So we want to keep that flexible. So today's topic is on the long run effects of pension financing through institutional investors. We have in mind private pension funds, but we also have in mind institutional investors such as the state. And on the macroeconomy, and especially on long-run productivity. So let me hand over to Jim to tell us a little bit on what are the key macroeconomic consequences of pension finance investments.
Great. Alex, thank you very much and for putting this panel together, and to the group for coming together on this very timely and important topic. I think it is appropriate to think about the asset management side of pension finance for two reasons. One, the pools of assets that have been accumulated in various types of pension structures are now quite substantial. I looked, for example, at the OECD Pension at a Glance review document, which calculates that across the OECD at this point, pension assets account for at least 1 times the annual GDP of those countries. And in several countries, Denmark, the Netherlands, and Iceland, for example, they are now more than twice GDP in those nations. 7 other countries, including the US, come in the 1 to 2 time GDP range. And what's notable is in the OECD document, which I find extremely useful as a summary of information on pension finance, there really isn't much attention to the question of how the assets are managed, and in particular the role of the private sector versus the public sector, and the intersection between the governance structures around the assets in the plans, the asset management component, and then ultimately what some of the consequences of those management structures might be. So I think this is a useful topic for us to talk about today. Just to kind of set the stage, I think there are really 2 levels at which we might have this conversation, right? And one is the macro aspect, and that is to say, if in fact the assets that have been accumulated in these funds are net additions to national saving. So if we thought, for example, that the mandates to accumulate assets in pensions in some countries were in fact an outward shift in the saving rates in those countries, so that saving that would not have otherwise taken place was going on, the natural framework for us to think about what are the consequences for firms writ large would be to say, how much additional savings got done, and then to embed that in our favorite growth type framework and say, how much would the additional saving have flowed through to additional capital which was accumulated, And at this point, you would have to stop and say, is this a closed economy? Is this a small open economy? The answers would likely be very different in the sense that closed economy analysis, we'd probably conclude in a relatively small country that an increase in savings would have an impact in making firms more able to access capital. That would lead, we would expect, to a higher level of productivity of labor in the country, but also a lower marginal return to capital as a result of having a lot larger supply of capital. If, on the other hand, it was an open economy framework, the capital could be widely diffused around the world in terms of investments. The effect on local rates of return would presumably be much smaller, and tracing through the impact on firm behavior and firm rates of return would be a more complicated undertaking and might be much more modest in terms of the overall capital stock because of the size of that capital pool. So that's kind of how we would think about the macro side. I think we'll come back later to talk about transitions and going from an unfunded to a funded scheme. And the word implicit versus explicit debt will have to be very important in thinking about that, because we have to really ask the question, when assets are accumulated in these funds, what is the alternative, right? If the alternative was an unfunded system in which there were promises to potential retirees, the consequences of building the asset stock might be very different than if there was no program in advance. And similarly, the consequence of shifting from, say, a publicly provided to a privately provided system might be very different than the consequence of creating the private system out of nothing that was there before. So I'm sure we'll come back to some of those issues as we think about it. But I think it's important to flag at the outset this macro context in which we could take these questions on. But then there's a second question, and I think it will probably be more of the one that we focus on today, which is, how does the actual behavior of the investment entities, the private sector firms like pension funds or insurance companies, which are active in this place, or the public sector institutions, things like here in the United States, the CalPERS or CalSTRS or other government-sponsored entities which are managing substantial pools of assets, how does their engagement in the system influence the long-run productivity of firms, and what is their more broad consequence for capital markets? And I think here again we can think about a number of different questions that emerge once we put the asset managers front and center in this dialogue. One of them is, are there ways in which these asset managers are likely to channel capital which are different from what would happen in the absence of their presence in the capital market? Those of you who are active in the asset pricing community will know that there's a wind blowing at the moment, at least in North American academic circles, toward what's known as intermediary asset pricing, which places a great deal of emphasis on who the owners of the assets are, because there may be consequences of who the owners are for the way in which the assets are invested, and therefore on the real side of the economy. So I think we want to anchor the discussion today very much in the context of the intermediary-based asset pricing framework, and then ask the question, what happens if we bring a private pension fund or a private insurance company into the market and increase the asset pool that they have at their disposal? What does that lead to in terms of downstream consequences for the firms that ultimately are the capital recipients and undertake the real activities in the economy? Well, that of course comes to the question of what kinds of investments will be chosen by these pension intermediaries, and what are the consequences of doing that? As soon as you raise that subject, right, it seems to me that the concept you need to work through is whether these intermediaries are large or small relative to the pool in which they are investing, right? This is a little bit analogous to the ESG debate or the divestment discussions that sometimes go on in other aspects of current capital market debate, right? Because there, the question of if an endowment institution decides that it will divest from a particular class of securities, does that action have the effect of changing the cost of capital to those entities, or does it simply swap the institutional owners of the securities in a way which has very little in the way of consequences for the downstream firms that might be doing investing? At the same time, right, there's a question of whether the institutional owners of the pension assets are not just making portfolio picks, but are becoming active, not in the activist sense of taking board seats and other things, but are in various ways engaging with the managements of the companies in which they are taking investment positions. And that could come on a number of different levels. It could come from the fact that they are potentially longer term investors than many other investor groups in the capital market. And there could be immediate consequences for the management and for the investment choices of the firms they invest in, just from knowing they have long-term patient capital. This is a topic that's been debated a lot, at least in the United States, about whether we have short-termism in capital markets, and pension investors would be canonical examples of long-term investors who can take a very long horizon in the investments that they undertake. But of course, it might also be that the investors on the pension side have particular preferences, whether they are ESG related, and we can certainly talk about that in the context of our discussion today, or whether they are related to other aspects of the firms that they would like to deploy capital toward. And as a result of that, right, there's then a question of whether they are good at picking firms ex ante, and then their ex post performance looks different than other investors just because of the talent of the investing skill that the pension funds might bring. And there's a question of whether they engage with the firms and change what the firms do, and therefore have consequences for capital markets. That, I think, tees up what to me is the real question for us today, which is, do some of these behaviors that the investors take, the pension investors take, ultimately affect the way in which the firms they take positions in, deploy capital, choose which projects to invest in, and therefore have consequences for productivity and investment returns? And I think with that kind of overview, both Josh and Roel have done research on these particular questions. So I'm eager to turn over to them in some sense to let this discussion continue.
Yeah, thanks a lot. Thanks a lot, Jim, for these two aspects. And let's directly jump in and take this second perspective on the productivity of the investment channel. And Roel, you've written a recent paper in which you looked at Danish data, asking exactly the questions: if pension fund investments make a difference, what's the effect on firm productivity? Can you tell us a little bit about your key findings on this aspect?
Yeah, thank you, Alex, and thank you for having me here. Let me share some slides. I will just talk about a few slides, and let me share. I move up. I'm talking. This is still ongoing work. It's work with, among others, David Pincus and other people from Copenhagen Business School. And Jim was already alluding to the increasing importance of pension fund assets. And actually the extreme examples of these are Denmark and the Netherlands, where those assets are about twice GDP. What we did, we took data for Denmark. Denmark has excellent data. And we use these data on firms, data on pension funds, to see whether investments, equity stakes by pension funds in firms in Denmark, whether they had a productivity effect. And let me just scroll down and say a few things more about the data. So we use, it's a very large data set. So we use data from Danish firms, all incorporated Danish firms. One of the complications in this research is that firms or pension funds may own a firm, and this firm may own another firm. And so we have to somehow deal with these, this complex web of ownership, and because we want to go to the ultimate owner. We combine these data with firm level data, and we take those from administrative data from Denmark statistics, and we focus on the somewhat larger firms, so as of 50 employees. And finally, we also combine this with some financial market data. Now, I will not go through all the details, but what I want to show you is the following, and that is some estimates that I show here. And what we do here is we estimate the effect of pension fund investment on firm productivity. And when you do this, one has to control for inputs, labor input, workers, capital input. And what we show here, I will explain the number. That is, what is the effect of a pension fund investment in the firm's equity on productivity of the firm? We call this total factor productivity. Within our data set, which covers 2005 to 2016, we find that the effect of investment, a stake of at least one pension fund in a firm, is an effect of 3.5% higher productivity. So it's a substantial effect. It's also highly significant. Now we go through all kinds of robustness exercises. For example, we control for the effect of whether the firm is an exporter, because being an exporter also, we find that that also increases productivity. But it turns out that the presence of pension fund investment is, comes in addition to the effect of being an exporter. We also look at the intensity of the investment. So we sum the pension funds investments in the firm. And so we take the total percentage of the equity of the firm that is held by pension funds. And we see actually when this, when the share held by pension funds increases, then productivity increases. And the effect is actually, it's quite large. For each percentage point, we find about 0.27% increase in productivity. And then finally, what we also do is what we look at the length of the investment. So for how long has this investment in firm equity, for how long has a pension fund held this investment? And we see that a longer tenure has a positive effect on productivity. Now, it is there may be several channels through which the investments by pension funds affect productivity. And so, for example, one of the possible explanations is that pension funds are long-term investors. They have long-term liabilities, so they can match this with long-term assets, and providing financing to firms means that these firms have are assured of long-term capital provision, and so they are able then to invest in productivity enhancing technology. That would be one channel. Quite interestingly is that when we, and maybe it's a little bit difficult to explain this table, but I think it's quite important. We also distinguish between investments in listed firms versus unlisted firms, all in Denmark. And what we see is that actually the productivity enhancing effect of pension fund stakes in firms is mostly concentrated among unlisted firms, which may not be too surprising, but still I think it's interesting to find this, because these unlisted firms are probably most capital constrained. They find it harder to obtain financing. And so, having a pension fund on board, well, it provides direct funding from the pension fund, and it may also give a signal to other investors that it is worthwhile to invest in this company. So this is just a brief overview of the results that we find. One final thing that I wanted to say is the following. I think so. Pension funds are long-term investors, but you can also have insurance companies, life insurance, that could be long-term investors, and a priori we would expect similar effects. When it comes to the role of regulators, I'm involved with a pension fund in the Netherlands, and regulators, at least in the Netherlands, but I suppose in other countries as well, they look at the safety of individual institutions. And so they look at, what is the probability that the value of the assets falls below the value of the liabilities. But they do this at the individual level without generally taking into account, okay, if you demand as much security as possible from the individual institution, what does this mean at the aggregate level? That means that maybe at the aggregate level, this pension sector has less capacity to invest in productive firms. But let me stop here and hand over. Thank you.
Thanks a lot, Roel. So one question that just came up for me, when I looked at these results, in particular, when you talked about unlisted firms and potential capital constraints, that the investments of pension funds may also send a signal through the market, is of causality. This is signaling to the market that these are productive firms you should invest in, or if this is really increasing productivity. Maybe you want to say one sentence on that, and then I would like to bring over to Josh to bring in the US perspective after we've heard the European perspective.
Yeah, no, this is of course the key issue with any econometric analysis. We try to control for, to ensure that there are no differences between the two groups, in which after the investment by the pension funds, the groups start to differ. But before they are the same, and and we do in the econometric analysis, we do some we control also for past productivity, etc. So we try to take care of that, but of course it's the key issue, of course. Yeah.
Okay. Good, Josh. Can you please bring the US perspective after we've seen this European perspective on the Danish data?
Absolutely. Well, thanks very much for having me here, Alex. So Roel presented some very nice results about his paper that shows that Danish firms experience an increase in productivity after they get an increase in investment by Danish pension funds, or after they get an investment by Danish pension funds. And the way that I interpret his results is he shows that in this institutional setting, that pension investors, under the right circumstances, are providing some kind of important corporate governance discipline compared to whoever the alternative owner of the asset was or would have been. And Roel and his co-authors point out that pension funds are long-term capital, and indeed, as he showed us, the effect is stronger for pension funds that hold the equities for longer. And intuitively, it stands very well to reason. I mean, you can imagine two extremes. A pension fund that is investing in stock is naturally going to be holding it for a longer period of time than, say, a hedge fund engaged in algorithmic trading. Long-term investors are going to be more engaged in disciplining the firm to maximize shareholder value. And so that the way I interpret Roel's results is really in the context of corporate governance. Now, bringing in the U.S. perspective. So in the U.S., pension fund ownership of stock increasingly means ownership by large state pension funds. So as Jim mentioned, the California Public Employee Retirement System, or CalPERS, that's a $450 billion pension fund. California has a couple other enormous pension funds, one for teachers, one for certain employees of the University of California system. And then every state actually has its version of CalPERS or CalSTRS, the university, public university retirement systems. And so together, those pension funds control around $4.5 trillion of assets, around half of which is in publicly traded stock, around a quarter of which is in private equity and other alternative asset classes that also would be thought of as equity ownership. And so I think that the US setting is one where we wouldn't want to just take Roel's results and just apply them and say, clearly in the US, we wouldn't want to conclude that US pension funds would have the same positive productivity impact on funds that they invest in. And I think the big difference is that these state funds are rather specific entities. Something I'll say about them that I think might be surprising to some people here is that the investment staff of the public defined benefit pension plans in the US tend to be relatively small. given their financial size. You know, you would think that a fund like CalPERS, a $450 billion fund, would have an enormous and incredibly sophisticated investment staff, but in fact, they don't. And in most cases, for most pension funds in the US, their executives are compensated more like bureaucrats than like Wall Street executives who would have, you know, high-powered incentives who have really a lot of pay for performance. CalPERS has recently moved towards introducing some pay for performance for their relatively new CEO, and there was some public outcry about the idea that the CEO could potentially earn a few $1 million in a year where CalPERS did extremely well. Well, you know, for a $450 billion pension fund, if the CEO can manage to generate good performance, well, I mean, I think that would be, you know, that would be deserving of some pay for performance. So the reason that I bring this in is that most pension funds in the US, again, you know, the managers of these funds are not exactly the people who have the incentives to really improve corporate governance. And, you know, well, one thing they do is, I mean, they will have blockholder power, you know, in comparison to, say, an individual owning a stock. I mean, a big difference is the pension fund is going to have, you know, blockholders that will overcome the free rider problem as was you know, documented in the 80s by people like Grossman and Hart or Schleifer and Vishny. So they may be able to overcome that problem of, you know, small individual shareholders don't really have the incentive to go and try to really improve shareholder value at a given company because there's just too much of a free rider problem. So many, you know, everyone else is going to benefit from my efforts if I try to improve a company. Once you have large block holders, that problem is a little bit less severe. On the other hand, having these large block holders may introduce other governance challenges, particularly, and this was alluded to in Jim's presentation as well, because these large investment firms seem now to be pursuing some multiple objectives, not only shareholder value maximization, but also other metrics of, for example, social responsibility or ESG or stakeholder capitalism. And so putting that together with the fact that the pension funds are state actors now, and are state entities in the US largely, I think that it would be, if I were going to try to translate rules results to the US, I would say that the governance setting is probably quite different. I have no doubt that the US pension funds like CalPERS do have an effect on the way that the companies are managed and operated. But I think the activism these days might be more in the direction of ESG and social responsibility than in the direction of increasing productivity and hence increasing shareholder value.
Thank you very much for this perspective, Josh. So if we take this and look at the government's question, if it should be run by more from the private side or the state, and then should the perspective be on social responsibility goals or on productivity? These are important questions. So what can we learn from this comparison, Jim? Should the pension funds be held by government state-run funds, or should it rather be the private sector in order to achieve the productivity gains? What is the normative angle here?
Yeah, I mean, let me, Alex, sort of start by sort of embedding this question in a kind of broader public finance framework for thinking about what's happening here, right? And this is very importantly distinct from a private sector pension plan, where the objective there, managing a defined benefit plan for a publicly traded company, the incentives there roll up through the CFO, and you basically think that whatever it is that the company is trying to do, if that is shareholder value maximization, for example, that the managers of the pension assets are in some sense trying to achieve the same long-run objectives, so that minimizing the amount that the amount of firm cash flow that will need to be devoted to defeasing the DB pension liabilities would effectively be the goal that you'd expect the management team running the pension assets to have. When you bring this to the public sector context, as Josh just began in his remarks a minute ago, it fits into a broader perspective. Ultimately, it is some combination of the current and the future workers, the current and the future public sector employees who may be contributing in some way to the plan, and the taxpayers, critically, who are likely to ultimately bear they are the contingent liability holders in these plans, who need to figure out what objective they are trying to maximize, right? And I think that if you take a very strict, I'll call it the intermediate good perspective on the pension plan, right? That this is just an instrumental way of providing compensation to workers, or if it's done at a broader government level, it's a way of providing income to retirees. You might just say, well, the objective should be just the same as if this was a large corporation's DB plan. We should just maximize the return and see how effectively we can minimize the actual cost of delivering this pension. But that may not be the way in which public sector actors in particular would think about this. So it immediately opens the door to ESG investing types of issues, which might come along. I know, for example, and Josh can certainly talk more since he's done much of the research in this area. We have evidence in the US that there is a tendency for home bias in the investments of state pension plans. They tend to invest in the assets of companies that are based within their state. And that could, of course, be, you could have, there's a good interpretation and a less favorable interpretation. The good interpretation might be that they are able to take advantage of informational asymmetries and that they have more information on the firms that are located nearby, and they therefore decide to invest disproportionately in those securities. The other interpretation is that they are under a variety of political and other stresses, which lead them to choose to invest in kind of a form of closet industrial policy, making investments in firms which are nearby. Now, that would, you would think on average, lead them to get lower rates of return than if they were taking the same assets and trying to deploy them in a unconstrained way, because effectively what I've just described is adding an additional constraint onto the asset allocation problem that, all else equal, probably would reduce your ability to maximize the rate of return of the portfolio. So, but I think that the bigger picture in this context is, the pension assets in the public sector fit into part of a broader public management and public sector decision-making role, where the rate of return may not be the only consideration, which is driving the ultimate rewards to those who are charged with this. And I would sort of point to two different things here that can come up. Right, one is just a non-return objectives, and we could have an interesting discussion about whether if the voters of the state of California decide that they're prepared to pay more in taxes to defease the liabilities to pay the pensions to their public employees because some of their public pension plans earn lower rates of return as a result of pursuing non-market return objectives. That's something which it may well be a decision the voters want to take. I think our finance perspective on this problem might push against that, but I think we should recognize that there is at least a possibility that this is just them choosing to devote their resources to that. But I think there's another element here, and Josh's comment about the staff size is very important. And I would call that the expertise element of this, which is, in many cases, the challenge of achieving high returns now requires at least the capacity to understand significant sets of complicated strategies that might be available. And whether you want to wrap this in, private equity investing or doing venture investing or other things like that, right? These are hard asset classes in which to generate frontier level returns without a significant investment and experience on a team. So either the public sector funds are going to need to build that in-house expertise, which does require significant size, or they're going to need to buy that expertise by hiring outside managers. And then the question is, how do you judge the performance of the outside managers and figure out what you're getting? I think that the LDI experience in some of the UK private funds, private sector funds in the last month or so, reminds us that the asset holders in some cases may not have complete clarity on what exactly they have purchased in the context of some of the complicated strategies that may be offered to these long-term asset holders, right? I'm not presuming to know that the sort of downside risk was not understood by at least some of the investors, but I think we've had some examples of cases in the U.S. I'm thinking back to the city of San Diego, the city of San Diego in the United States, which ran into some financial difficulties at one point about 2 decades ago, where complicated derivatives were part of a portfolio that was being held by the public sector funds. But in fact, some of the risk profiles of those were not completely transparent. So I think those are some of the trade-offs. Let me stop there because I want to make sure that we have time for both Josh and Roel to jump in on this one.
Okay. Before I give the word back to Josh, because you just mentioned his research, we have one question in the chat by, I think this is Martin Boyer, right? Do you want to unmute yourself and ask the question directly? Martin? I don't hear him. He cannot. He writes me he cannot. Okay, then I read out the question. Should we expect the rise in interest rates affect the pension plan's stock ownership? Would it differ between private and public plans? That a question to Jim or to Josh?
Well, I'll comment on that a little bit. I think the first thing, I'm coming from a U.S. perspective, the first thing to notice in the U.S., the private corporate defined benefit pension plans and the public plans are regulated in completely different ways. So the private defined benefit plans, which are now small compared to the public defined benefit plans, are regulated under federal law, going back to a law called ERISA from the 1970s that specifies ways that liabilities must be measured and also how they have to be funded. And actually, what's happened is there's been a real move towards much less equity investing by corporate defined benefit pension plans, while at the same time, the state plans, which are essentially unregulated, they're certainly not regulated by the federal government. Each state may have its own constraints that it places on its own, defined benefit pension fund, state level defined benefit pension funds. The public funds have gone much more in a risk-seeking direction, moving much more in the direction of equities and alternatives like private equity, real estate, venture capital, and so on. So whether the rise in interest rates will have an effect in some ways of reversing these trends that we've seen a little bit. I mean, it is possible, as some defined benefit pension plans that have risked up a lot in recent years might see there being yield opportunity in the fixed income market that there hasn't been in quite some time. So we could see some response on that front. The public defined benefit plans, the CalPERS type entities, what they're really focused on is maintaining their targeted returns. They've got return targets that they really have to be able to meet. And generally what they're doing is putting together an asset allocation that in expectation is going to meet that return, but it's not guaranteed to do so. So I think with higher yields, it's possible we might see some return to fixed income investing by the public funds. I did want to just comment a little bit more on the question of the public fund governance and different strategies that they might undertake. And I think Jim is exactly right that if it's a matter of public choice, the tax-paying public, which in the U.S. Case is really the group of people that is on the hook for bad performance in public pension funds. If the tax-paying public has a preference for socially responsible investing at the expense of financial returns, then it's a question of social choice. One set of findings that we discovered is that sometimes the variation in state performance with respect to public governance seems not that intentional, from the perspective of actually trying to achieve social goals, and instead is a function both of the degree of financial knowledge of the governing boards of pension funds, as well as the extent to which they are political insiders. So in work with co-authors Alex Andenoff and Yael Hochberg, we found that many pension funds have board structures where they're either political insiders, such as the treasurer or governor of the state, or financially rather unsophisticated rank and file members, or both of these, calling the shots over tens of billions of dollars of pension fund money. And we find that representation on pension fund boards by state officials is negatively related to the performance of their investments, particularly the investments that they make in private equity, and that boards that have large numbers of rank and file members who don't exactly have the financial background to be able to really control and assess what's going on, that they also underperform. So I think that there's a distinction that has to be made between intentionally serving the non-financial interests of the public and just having bad governance that leads to bad performance.
Good. There's another aspect to get bad governance that I wanna take up in a second. But before I do that, Christian raised his hand. So you wanna unmute yourself and ask? You already did.
Yes, thank you, Alex. It's a general question. Is that the right moment, or?
Yeah, just go ahead.
Okay. Christian Thiemann from Goethe University. Thank you for these papers and the presentations. I think it's really completely fascinating. And it reminds me of the time when I was on the executive committee of a stock listed company for a couple of years. And when you're doing this, you're talking to CFOs and CEOs all the time. And there are two anecdotes that I like to share with you that stand out and that I think illustrate Roel's results from an anecdotic perspective. The first is when you do an investor day, a full day, you start with the strategy, you do the technology, your forecast, the societal issues, environmental issues, and at the end comes the CFO that says, how is it all pulled together in the financial forecast? And what you notice is only the pension funds ask questions during the first parts. All the other investors wait for the CFO then they open their laptop. They say, okay, what are the quarterly forecasts? What's the dividend next year and the year after and so on? And the whole discussion, you really give it to very few people. The second anecdote is when the CEOs, CFOs have dinner about dessert, they start to chat about their investors, and they all have troubles with their investors. And then they say, that's the story, they say, we should choose our investors, really. We should choose our shareholders. We always talk about the shareholders choosing the companies, but actually we should also choose our shareholders. And who's on the top of the list? Pension funds. They all love the pension funds. And I think, Roel, this for me would be three reasons. One, they share a long-term vision where every entrepreneur needs to have a long-term vision because you achieve nothing in the short term, nothing in the next quarter. Second, they do have a broader interest because they're interested in public policy issues, so environmental and social externalities. And third, they see you as a standalone business and look at you as a company and don't see you as currently in part of the stock market situation and trading vis-a-vis other companies and so on. I think that would be the three substantive reasons. And then there's a fourth one. If I ran your regressions, I would maybe do the control variable and check for activist investors. Because the thing that frightens everybody are the activist, short-term profit-oriented investors. And many, many stories in the US, in Europe, where activist investors threw over the corporate management. And I think the pension funds are so positive because they're almost incompatible with activist investors. So what I want to say is maybe what you would achieve with the same result if you control for non-activist investors. And I think these two things are really negatively correlated. So that's just what I would like to add to, from a practitioner's perspective, to this fascinating discussion.
Thank you very much, Christian. For the practitioner's perspective, is very, very useful, very helpful, and I think it's in line with what Rauh showed us.
Yes.
Bringing back this now that we are speaking about pension funds, we've seen the problems on the governance side, government investments, probably lower returns for the reason that Josh laid out. But there's this other risk of the incentives of the government, what to do with the funds that are hanging around in a big pension fund run by the government in times of crisis. So that's a risk that is clearly out there. What is our experience? What can we say on that? Is there an anecdote of?
Yeah, if I may, Alex, I want to go back to, if that's okay, to the discussion that we had on state versus government, state versus publicly run pension funds. I think the results that Josh, and he also worked with Alex, also from my university, and what they find, I think it's very important. And we have this, it's called ABP. It's a very big pension fund. It's comparable to CalPERS, and it's the fund for teachers, public servants, but it is privately managed. So it's a private entity, which I think it's very important, because I think the Netherlands has public debt. And I think in the 90s, there was some discussion about merging, the savings of the pension fund with the public debt, and the public debt would fall by a huge amount. And I think that is, in my view, one needs to have, separate the influence of the public sector from the management of pension funds. And I think what what Josh said is, I think it confirms that. And so the Dutch central bank is the supervisor of the pension funds in the Netherlands. They want to move towards more professional management of pension funds. And in the boards of pension funds, we see a shift towards finance professionals. I think that is very important, because you want to avoid political influence, etc. Because in the end, you need to service the interests of the participants of pension funds. By the way, that said, it's not the case that these privately run pension funds do not pay attention to ESG. They do, and there's a lot of public pressure. There's also pressure from the supervisors to pay attention to ESG, etc. But I think it's in a context that is probably healthier than in a situation where you have pension funds run by public sector officials.
Okay. Thank you very much. So what I had in mind is the Polish example was of 2013, right? When the government.
I'm not an expert on Poland, but I wrote a paper together with people from Poland, and after the fall of the Berlin Wall, there was a shift towards pension funding. And I think the issue here was, and that is, relates to what I was saying, is that there was still a lot of, control by the public, by the governments. And at some point, I think under financial pressure, for example, through tax law, but also just capturing assets of pension funds, these funded schemes were rolled back, and this did not happen only in Poland, but it happened also in other Central and Eastern European countries.
Okay, thank you very much. So suppose now, if we conclude from this discussion that that there is like a tendency for privately managed pension funds, they might also incorporate ESG goals, other goals than maximizing returns. How do we break the general problem that if we transit in an economy now over the next 20 years, we have this big aging problem ahead of us? I mean, this has been known since at least 20 to 30 years in academics. But how did we manage to transition? Can this insight that pension fund investments probably lead to higher return help us in the transition, and how do we finance the costs? Josh, can you say something on transitional dynamics in that context?
Okay, well, I think there are a couple of different facets of that question. You know, one is for you know, the large public systems like U.S. Social Security. Another is for private plans, and I think as you think about the demographic shift and the fact that there is going to be increasing dissaving by the same entities that have been doing a lot of saving, I do think that's going to put some some pressure on assets, and I think on asset returns, and I think in the U.S. One also has the generally kind of cash flow negative position of a lot of these pension funds in the US, where they really need very high returns just to maintain the level of assets that they have. And the reason is that they basically budget using expected returns as the assumed inflows that the pension funds will have. And as we know, when you're targeting an expected return of 8%, that might be a hope, but it's not a guarantee. And it's become in recent years, in an era during the years of very low interest rates, it was difficult to achieve and required taking on a lot of risk. Now that we see interest rates rising, that might help alleviate some of the pressure if funds want to achieve their returns with their targeted returns with somewhat less risky portfolios, but they've been sitting on all of these very interest rate sensitive equity investments, and those have taken a huge hit. So I think that the demographics are going to be a challenge for pension funds, and that they're going to face some headwinds.
So this is like the key challenge that we are facing, right? On the one hand side, the demographics is the key challenge for the implicit returns of Social Security. On the other hand side, it's also a key challenge for the returns on pension fund investments. Is there like hope, like if a selected portfolio choice with a long run perspective for pension funds to make higher returns for the long run for financing pensions in the future? Roel, what do you say?
I think it's too optimistic to think that higher returns will make up for the demographic developments. I think that is that is wishful thinking. Yeah, okay, returns. So interest rates have been going up. Well, I mean, of course, stocks have taken a hit, and so now the expected returns will probably go up, but this will not compensate for the demographic dynamics by themselves. And by the way, it's not only more pensions that have to be paid out, but it's also healthcare, and which is probably maybe even bigger bill. So I think it will be inevitable to gradually raise the retirement age as life expectancy increases, or you have to accept that pension benefits will fall, and that is also a possibility. But I think this is inevitable. And actually, in our country, we have a kind of an automatic scheme by which the retirement age is linked to the to life expectancy. This is for the public sector, for the public pension, well, for the public part of the pensions, because this is the first pillar, and the second pillar, so the pension funds. This is typically, how you say, related, so it follows the retirement age for the public pension. And but this is, I think, this is the only solution if we are not willing to accept lower benefits. Higher returns can help, but I don't think, it's a, how you say, it's a solution for the demographic development.
Yeah,
So it's worth keeping in mind. That in the U.S., I mean, the entire private sector is now essentially, with the exception of a sort of legacy defined benefit system that affects employees of older companies. The entire private sector is essentially in an individual accounts defined contribution world. So those the private economy individuals are basically depending on stock and bond markets for their retirements. And one of the big innovations in the U.S., something that Jim and I started studying a long time ago, is the life cycle funds as ways of trying to rebalance the portfolios of individuals who have these 401k, these individual retirement account types of plans in the U.S. to rebalance them towards less risky portfolios as they approach retirement. Challenge is that a lot of them glide path into fairly long duration nominal treasury bonds, which have gotten absolutely hammered during the recent increase in interest rates, and there might be more to come. So what appeared to be a safe portfolio actually turned out to be not that safe. If I had to give some kind of prescription for how to try to get over this in some way, I think all of the models would point to the thing that would help would be to somehow increase the savings rate. In the U.S., I mean, the savings rate now, personal savings rate is back down to 3.1%. That's as low as it's been since before the financial crisis. It's very low by international standards, and it goes back to the discussion that Jim teed up at the very beginning about the question of if you go from an unfunded system to a funded pension system, can you will that actually increase the capital stock and hence the productive output of the economy? And the only way that it will is if savings actually increases. If by shifting from this unfunded system to a funded system, you're not just swapping unfunded liabilities for government debt, but you're actually somehow initiating a system where people are defaulted into saving more, overcoming behavioral biases that they have against saving, or through some other mechanism are saving more. I think that is the way to somehow try to push back against the headwinds from the demographic pressures. We somehow raise the savings rate.
That's a difficult perspective, right? For those that need to save, increase the saving rates, and now in a high inflation period, how can they do? What could governments do? And on top of what, I mean, in Germany, we have this subsidy scheme, but it didn't really fly because there was a lot of net zero effects into the pockets, out of the pockets in terms of these subsidies, and it didn't really reach the lower income quintile. Because they didn't get the information on these subsidy programs. They are not in contact with bank clerks all the time, right? They don't receive these products. So what is an angle that governments could do? Maybe, I mean, we are running towards the end of the session. So let me just bring this last question that I have now to Jim, and then maybe one short round of concluding statements by each of you.
Yeah, well, I mean, first, I just want to endorse both Josh and Roel's remarks on the transition issues, which I think tee up exactly the right set of points. I would just add one, fine point on this, and it really is channeling an observation that Nick Barr and Peter Diamond have made in some of their work on reforming pensions. There's a tendency, I think, to believe that if we can deal with the implicit liabilities that are out in pay-go systems by issuing debt, formalizing the liabilities, and then saying, okay, now at least we know what we're dealing with. That inclination has much to recommend it, but one downside to that is that by formalizing the liabilities for the indefinite future, right now, you actually may give up some of the flexibility that is associated with being able to reduce the benefits if need be as you go forward, right? And it's exactly what Roel was saying. I mean, there's no escaping the dual headwinds of low returns prospectively and demographic change with aging populations. So we are going to have to fund these liabilities either by reducing the consumption of those in the economies that have taken on these liabilities, and that can be spread in different ways across different age groups. It would be unusual, I think, to end up not spreading some of that pain to the potential beneficiaries of these older age focused programs. And the flexibility to do that, the flexibility to do the sharing, I think is very important to preserve. In countries where, the automatic indexing to some measure of life expectancy is in place, or other kind of automatic adjusters are there, those systems are much more resilient to shocks that might confront us on the demographic side. There are other ways of building in stabilizing forces with respect to rate of return shocks would be very helpful, right? I mean, as Josh was just describing the life cycle funds in the US, when you get a simultaneous decline in bond and stock markets as we have in 2022, those are not very resilient, funding mechanisms for retirement in the face of a shock like that. So I think preserving flexibility, trying to have resilience in the systems that we have, but continuing to think about these very important issues, as this panel has done, strikes me as a very important recommendation for going forward.
Okay, that was a very nice last statement, Jim. Thank you very much. And Josh.
Well, it's going to be hard to follow that. I agree with everything that Jim said, and I think it's going to have to be some kind of way of reforming our pay-as-you-go systems, which are completely unsustainable, preferably in ways that would also lead to some funding that would actually increase the level of savings. And I think what we've learned from the economic literature and also from experience is that it's hard to do, because you end up just replacing this implicit liability with an explicit liability, and then, as Jim said, you lose the option to actually negotiate on the implicit liability. So I think that's very important. I also think that these governance issues in funded pension plans, and particularly public plans, have got to be worked out and improved. It's all well and good if the public is actually voluntarily supporting non-financial objectives by large pension funds that provide retirement for state employees, and they're voluntarily saying, we're willing to bear the downside if it turns out that there isn't as much of an alignment between ESG principles, financial returns as we thought. That's all well and good, but too often that's not the driver of the weaker returns that we're seeing. It's just poor governance, and so I think governance reform for large pension systems that is going to be more focused on as I think as a first principle, maximizing shareholder value, traditional shareholder governance, and then layering on top of that ESG in a well-considered sense would be the best way to address a number of the issues in these large funded public systems.
Thank you very much, Josh. And last word to Roel.
Yeah, so thank you. I want to go back with what Jim started with, the role of pension funds in potentially increasing the savings rate. I think that, so in the Netherlands, there is largely mandatory pension savings, and this happens through sectoral pension funds. And I think it's quite well documented that the total savings rate is actually quite high in the Netherlands, and it seems that there is not a perfect substitution of substitution away of just voluntary saving, but so having mandatory pension saving can be a way to increase the savings rate. Now you can say, well, I mean, so our country, unlike the US is to a large extent a closed economy. Our country is a very open economy still. We see that there is a bias in pension, in the allocation of pension assets towards the home country. And I think this is also the case for Denmark, which is maybe even more open than our country. So I believe in the role of, if you want to raise the savings rate, I think then, mandatory saving or part of the income via pension funds could be a way and a way to raise savings, could stimulate investment in the own economy. And in my view, it would also benefit workers, because many of them are, well, I mean, it's just a fact. They are short-sighted. They don't take long-term decisions. And so, by being, required to save via pension fund, you will actually help them. Thank you.
Thanks a lot. Thanks a lot for this very insightful discussion. In my case, I forgot to switch on the light. It's getting darker and darker. I hope this is not a dark outlook into the future on pension financing, but only the fact that the day is ending. Thank you very much for coming. Thank you very much for this insightful discussion. We learned a lot today. We opened a lot of questions, and this is always a very productive and nice output of a discussion of this forum. I wish you all a very good day, nice day, or nice evening, wherever you are. Thanks.
Okay, thank you.
Thank you, Alex. Yep.
Thank
take
you
care.
very much,
Thank you,
Alex.
Alex.
Thank you.
Bye-bye.
Bye. Great to see you all.
Thanks, everyone.